Share screen. Okay, guys. Just wanted to talk about today. What can we learn about macroeconomics, especially if you wanted to get started and you're like, where am I going to go for macroeconomics? And actually, Randy actually asked me that question, like, where should I start if I want to know more about macro? And really, it came to my mind there are a number of different things you can read that are good. But I thought The Big Short is a great place to start, and we're going to get into that a little bit why tonight. Why I think it is a great place to start with your economics theory in terms of macroeconomics. And a lot of lessons can be learned from the movie itself and from the philosophy, both before and after. So, real quick, we're just gonna. Why did macro fail? Because we can all agree pretty much they failed. Because literally, on balance, most economists had no idea. And then obviously the Fed didn't know it was coming because they would have done something, right? So obviously, macroeconomics failed us pretty badly. However, there are a few people that didn't. And back in 92 or so, and throughout his career, but seminal work in 92 or so, Hyman Minsky created a financial instability hypothesis. And essentially, if you look at his hypothesis and play it out, he actually was onto the causal factors that caused the GFC, and it basically played out essentially as exactly how he would have said it. And also, if you're interested, there are a few other folks for different reasons came to the same conclusion that things were not going to play out well. And finally, we're going to talk a little bit about how this time is actually different. You hear that all the time. Well, this time is different, meaning it's meant to be ironic. Is like it's never different. It's always the same thing. But we're going to talk a little bit about the fundamental differences in the last recession and what we're looking at this recession and why they are so wildly different, especially in terms of housing, because it is looking like a housing bubble with regard to how the market is behaving in terms of housing prices. You're seeing some collapses in prices, but it really wasn't the same kind of bubble. And we're going to talk about why that's really important. Also, the long run demographics are very bullish, actually, when you still look at the housing market. And so in the long run, if you can tolerate the pullback here, the long run setup looks really still pretty great. And then just a quick overview: COVID and Ukraine are mostly blamed for inflation. In that we'll look at a chart that I think is pretty insightful to show why inflation and how it's played out, and how COVID is actually mostly to blame and not necessarily just some random balance sheet issue from the Fed. All right. This is pretty insightful. This is remarks by Ben Bernanke, and I want to make note of the date. February 20th, 2004. I don't know if you can recall where you're at. But he said this quote: "One of the most striking features of the economic landscape over the past 20 years or so has been a substantial decline in macroeconomic volatility." In a recent article, Oliver Blanchard and John Simon documented the variability of quarterly growth in real output has declined by half since the mid-'80s, while variability of quarterly inflation has declined by 2/3. Several writers on the topic dubbed this remarkable decline in variability of both output and inflation the Great Moderation. Similar declines in the volatility of output and inflation occurred at the same time in major industrial countries, with recent exception of Japan, a country that has faced a distinctive set of economic problems in the past decade. Here's the kicker: reduced macroeconomic volatility has numerous benefits. Lower volatility of inflation improves market functioning, makes economic planning easier, and reduces resources. So why did I choose this quote as like the seminal quote of the pre-GFC thinking? I believe that this was the predominant thinking of most macroeconomists and how their models of the world were thinking, and what they were thinking in terms of, well, we figured it out. By Scott, great Scott, 1.21 gigawatts, we have this all figured out. And you notice what I used up here. we clearly had a ticking time bomb, and they didn't see it coming. And reminded me of one of my favorite quotes in terms of finance. And interestingly enough, I guess Mark Twain had got involved in some financial investing and actually lost his shirt. And I think this is the context of where this Mark Twain quote comes from. It ain't what you don't know that gets you in trouble. It's what you know for sure that just ain't so. And so that's why we turn to the Hyman Minsky take on things. And this was from his paper in '92. From time to time, capitalist economies exhibit inflations and debt deflations, which seem to have the potential to spin out of control. In such processes, the economic system's reactions to movement of the economy amplify the movement, and inflation feeds upon inflation, and most importantly, I think, debt deflation feeds upon debt deflation. Government interventions aimed at continuing to contain the deterioration seem to have been inept in some of the historical cases. These historical episodes, the Great Depression, are evidence, supporting the view that the economy does not always conform to the classic precepts of Smith and Walras. They implied that the economy can be best understood by assuming that the economy is constantly equilibrium sustaining and seeking system. So what he's saying here is that what the classical economists believe that equilibrium was like really what the economic system's trying to do. They make enough assumptions where they're saying, well, the supply and demand is always trying to seek itself out and try to balance. And what he's suggesting here is that because of debt, that doesn't always end up being the case. And so, and I think also what we saw after the GFC, debt deflation did indeed, once the bubble popped, it was a vicious cycle all the way down to some pretty hardcore economic results. And then this is a slide that was really interesting, describing the path of what happens in a Minksy cycle. Essentially, as the economy starts to swing up and get hotter and hotter, then speculative borrowing comes into play. Then Ponzi borrowing, where and I don't know about you guys, but what rang the bell for me on this was when you start thinking about how late in the cycle that crypto got really hot. And God's sakes, NFTs. I don't know if you guys saw what happened with NFTs, but it was just insanity to me that they got these, gifts, if you will, and they were selling for, ridiculous prices. So once you start to see a correction in the market, that's where the credit pop starts to happen, and where basically the credit boom leads to a credit bust. And when the credit bust happens, that's when we see the downturn. And I just wanted to shout out to a couple people that I recommend following, and I think that really can help you keep track, and why I think these are the people that got it right then and stayed on the path of trying to figure out, okay, well, how do we avoid this, and what do we need to know to really follow through and say, well, let's make sure these guys see how they're thinking about things and see if we're getting the right answer. I hate to say this, and I say this, reluctantly, as really a huge fan of my professors in undergrad in econ. I thought they were stellar. I thought they were great. But unfortunately, I think that institution of economics became kind of a religion in and of itself. And what Dr. Keen, and he's like, if you have one place you want to really get, what should we be doing with economics versus what we're getting? Dr. Keen really did a lot to say we need to completely start from scratch and do different things with modeling economics. Also highly recommend Dr. Robert Shiller. He did the Case-Shiller Index, you may be familiar with. And he did some really great work on narrative economics, how narratives can also create different things happening in economics. And I think again, the NFT, and you saw in crypto, what you saw with them doing late in the cycle, were very narrative driven. If you look at Tesla is another example. Why on earth was Tesla trading where it was trading at? So definitely narrative can be a huge factor in economics. And then also recommend Dr. Rajan, I can't really say his first name, but really a brave individual. Indian Federal Reserve in India was on their Federal Reserve there. In 2005 said, hey guys, I don't think what's going on with the financial markets, and more importantly, what's happening in the credit markets looks very kosher to me. So literally in 2005, it really kind of created a stir from what I understand in 05, literally before things started to blow up in, what, 2 more years. He was literally on the hunt saying, wait a minute, I don't think this is going to end well. And so definitely a name I highly recommend following. All right. This time is okay. This time is different, and it actually is. I mean it. Debt to income ratios are way different in the real estate housing market as a result of Dodd-Frank. And again, I believe the COVID inflation is the biggest culprit of housing turbulence, and it's not debt. Notice this time that these aren't a debt-driven bubble. This is correction from a different place. And then the war in Ukraine also unhelpful, in addition to be a disgusting waste. Here's a prime example of why I think that they're just so fundamentally different. Look at the housing bubble relative to debt and equity. So as we see here, the debt versus the equity, we were negative for a period of time, and then we started to recover. And then as the cycle went up, look at the ratio of equity to debt here. There's still so much equity to debt that we can afford even literally a downturn in real estate housing prices without being too painful. Notice we're not remotely close to the red line in terms of the debt to income ratio in terms of home mortgages. So it makes a huge difference in terms of what's possible in the market. This is the Fed balance sheet. This is where it gets really interesting to me. And one of the arguments I've had for a while is, okay, I know the Fed balance sheet is big, but notice that we jumped way up in 2008 when we flooded the system. It stayed pretty high for a long time, even, like 2014, 15, 16, 18 even. And we did not see inflationary pressure. So I don't believe that this balance sheet was the cause of pressure. So really this is where the big difference came in. We did find the line, and I think it's fair to say that we did find the line after 2020 when we flooded the system again with all that liquidity to avoid a huge downturn due to COVID. That, it's fair to argue that, yeah, that finally did get us to the point where we caused some inflation. But notice here, the balance sheet significantly got a lot bigger. And yet it didn't happen until we literally almost doubled the balance sheet into where we are now, essentially. So we did find a line in here for sure, but it wasn't this number, which before this I think would have been thought of as insane. Before the 2008 would have been like, what? You're going to have you're going to have that balance sheet? And then finally, this is showing how the Fed balance sheet versus the 10-year note bounced around. And notice that it was an interesting lag here. You see here the balance sheet went way up. And then finally, in a few quarters after, finally the interest rate started to really spike. So you did see it eventually, but it wasn't until like literally COVID hit. And that's why I have a strong belief that COVID is the central culprit. It's not necessarily the Fed balance sheet. It was just the response to COVID and how we flooded the system. So my conclusion overall is the Big Short demonstrated the Minksy theory to a T, and also helps us realize that macro is fascinating, that each cycle is its own animal and it might have some traits of the past, but not always. Also, today's real estate market is driven by tight supply and the response to COVID. The corresponding massive rate hikes are what's causing the change in real estate values, not a debt bubble. So I think that's an incredibly important distinction. And I think the harm that'll come from it will be significantly different than what happened in 2010 to the real estate market. I believe there's going to be a fairly significant recovery once rates start to come back down. I think we'll see a huge recovery fairly quickly in prices. And just finally, some further readings. If you love this stuff and can't wait to get more, I've got some recommendations for you. The Big Debt Crisis by Ray Dalio. I haven't gotten all the way through that one, but that has been an excellent read so far. I really think Models Behaving Badly is a great overall investor book. No matter what you're doing in terms of investing, I have to really highly recommend it. It's not well known, but it is an incredible read in terms of, okay, trying to building a model. There's only so much you can do, and keeping that in mind when you build your model. Another one I just got my hands on, the Hyman Minsky, Can It Happen Again? This is a great, I guess, what would be the word, editorialized version of some different folks coming together and talking about what the Minsky hypothesis is and delving deep. And then finally, as I mentioned before, Dr. Keene on macroeconomics and how we should really rethink how we should do economics is really a fantastic read, and I can't recommend that more. So thank you guys for taking a listen here, and then we will open it up to questions. Anybody have any questions about the presentation?
Mainly comments whenever, at least in regards to the balance sheet of the Fed and how correlated to inflation. It was a problem that no one could figure out for quite a while, why the Fed balance sheet's growing, but inflation isn't running off higher. And due to open market operations that they were conducting after 2008, that's what pulled us out. Opposed to in 2020 where they did direct stimulus injection economy. So there's a distinction to be made there.
Yeah, I don't think I can argue with that at all. I think the direct stimulus and the fiscal policy, in addition to monetary policy, was significant. And I think you're right. The direct stimulus was really, and again, we may or may not agree whether or not they should have done it, but it is what it is.
Right.
And so I think you're right. I think that is a significant difference on why that did have a different outcome for sure.
Yeah. I mean, when we look at how monetary systems work, if you just simply put something down or, put something into the stock market, which is what, 1 second.
Sure.
There we go.
Pleasure.
Thank you. So if we just directly put it into equities, which is, stocks and bonds, real estate companies, where it's not being put in to drive the consumer good, because you have your day traders who trade for income, but that's such a small amount of the population that it doesn't matter. The big hedge fund CEOs and investment fund CEOs, firms, what have you, make up such a small component. And, if they're making $100 million a year, it's highly unlikely that they're spending all of that, and buying a bunch of food, clothes, toilet paper, gas, and just giving it away to people.
Yeah.
So whenever you take it from such a localized 0.01% of individuals and then disperse across 150 million people all to go use at the same time, yes, earnings went up in companies and different types of growth within the markets. It's broad-based consumer that actually tapped into things such as GDP, and then now you have that problem because it's all they've effectively done is put it on a credit card is what it is. I mean, long story short,
right.
If you double your credit card, your credit card now has less purchasing power. You can't use it as much, and you need to down and pay that off before you use it again. It's the same kind of concept that we had in 2020. We were using our credit card for, gas and maybe some food here and there, and then all of a sudden we started paying all of our bills and buying Rolexes with it.
Right.
Now, there is a lot of hidden debt in the marketplace. That's prime. So the BIS paper on Forex derivatives came out like 3 weeks ago,
Mhm.
and some pretty nice insights as to the amount of hidden debt that's out there.
Oh,
I
that's fascinating. Can you
I
tell
don't
us a little
know.
more about it, or do you have it?
Yeah, I have a whole article written about it.
Okay, great. Love to
Uh,
see more about that.
yeah, so we can dive into it more if you want, but basically, our monetary system and credit system is US dollar centric. So the
Mhm.
lion's share of international debt, trade invoices, asset classes, and Forex volume is settled or denominated in US dollars.
Right.
And direct access to dollar liquidity is only available to entities located in the United States, but a credit based system the rest of the world also has a large incentive to leverage in US dollars to boost their global business model. So, EU banks, Brazilian corporates, Japanese insurance companies, whatever, who want to do global business will most likely get exposure to dollar denominated assets and liabilities. It's going to be our debt, despite being domiciled outside the United States. The required US dollar funding happens both on and off the balance sheet, and the Forex derivatives market is the important part of that and the focus of that BIS report that came out. So, I mean, we can. Do you want to dive into that, or do you
Well,
want to off of
yeah,
that?
I think we could do several things with that. Number one, we could dive into it now and let's do it live. We could also set that aside for another presentation, which may be the way to do it, is unpack it for everyone, because that one has huge implications, and maybe we want to unpack it and really delve into it. That's a great question. And again, I leave that up to you guys too. If you want to know more about that now, or you want us to unpack it and drill down more into what we're talking about in the implication.
Either way works for me, whatever you want to do. I'd like to know the hidden fees, the hidden.
The things that are hiding.
It's
Mhm.
gonna get deep and complicated.
Yeah.
Okay.
And that feels like we should support that with a PowerPoint and kind of more graphics if we're going to do it. I think that it is very fascinating, and I think it definitely deserves it. Maybe we do that for next week, and we unpack that one, because that does sound really good.
I've got the graphics already for it, so
Sweet.
we can
I would
just.
like to go deeper and more complicated, please.
How does this make us money, or how does this save us money?
No, I'm sorry. I was actually on a call, so I only came into the last part, but point still stands. I would like to go deeper and become more Let's do it more complicated.
That's right.
All right. Do we want to do it now, Douglas, or just set it up for next week?
I'd say set it up for next week. We'll unpack it, and again, it is recorded, and it sounds like it deserves a PowerPoint of its own, really, to me, and slow it down so we can share the love.
Sounds like a plan.
Also, I want to recommend. I don't know if you guys are familiar with Peter Zian. Am I saying it right? Really great great work on demographics is destiny, but he has some very interesting things to say about the breakdown in the global economy and how we're breaking back down into more regional economics versus a globalization. So we're seeing a reversing globalization. And if you want an investable thesis from all of this, maybe long Mexico might be an interesting thesis that we could look at on that. But that's also something I'd like to tackle here in the next few weeks because that's
Douglas, there's one big problem with long Mexico, which is all the rich Mexicans, regardless of what's going on, they always move their money here. So the people are speaking, and they don't trust the political system there.
So the political stability may just never be good enough to really
I don't
get
think
too
it's
excited.
ever going to be good enough.
So
I mean, the people, the funds flows are literally telling you this.
Yeah.
So the people have voted, and the people that matter have voted. So
with their dollars leave.
You're taking a contrarian position.
Yeah.
I mean, if we just make Mexico the 51st state, that's possible.
Okay,
I don't
so
think we would do that though. I think that's
No,
I don't
we
think it would ever
would.
happen.
It's very unlikely.
I think we should start with Canada first. That'll be way more easier to accomplish, I think.
Yeah, but
Oh,
I think doesn't require 2/3 of states to ratify it. It'll be too difficult to get anybody to ratify it.
I mean, we can't even agree on
Whether there are 3 genders.
right. We
There's
can't
3?
even agree on that.
Yeah, we
Never.
might need to make sure Texas and Florida are states first before going to Canada.
Right. I mean, let's try to get Puerto Rico into the 51st state and see how well that goes. I can tell you how that's going to go.
I think the only way Puerto Rico becomes a state is if DC becomes a state as well.
Like a quid pro quo.
Well, like you don't want a 51st state without a 52nd state.
Well, the problem is they're both going to be overwhelmingly Democratic, right? So
Yeah, I was going to say, I
don't.
don't think that's going to fly.
Not like
either.
back in the day when you had one slave state,
Yeah.
one free state, one slave state. You're going to get two Democratic states.
That's 4 Democratic senators for the price of 0 Republican senators. I don't think that's
Right.
going to go anywhere.
Yeah, probably not. But
Without regard to politics, if we're just being analytical, without making a comment on the veracity of the underlying points of each political party, we're just talking mechanics here and realities. Maybe I don't know.
yeah, I mean, do you think Puerto Rico would be Democratic?
Oh, certainly, yes.
Yeah, it's like probably 90%
Oh, I would think so. Yes. Yeah.
or more would vote Democrat.
Yeah, so then that's not going to happen.
No. Same with DC. I think that's there's
Yeah, DC
a
will never.
fair argument to make DC a state, but I just don't. Yeah,
I-
don't see
I-
it.
They want to do it, but it's not going to happen. The only way it happens is if we, on the Republican side, get a Republican state, and Canada wouldn't do it.
How about let's give you the free states of Northern California and Southern Oregon.
We need
There's
to. Okay, we need to do that, and then we
Yeah.
need to make Chicago its own state.
The city state of Chicago,
If-
Chirac.
If we did Chicagoland as its own state, I would continue to live in Illinois. I really would. Other than that, that's why I'm leaving, is because of Chicago.
So what's our thesis on next year in the stock markets, Dylan? Is it going to continuously go down? I think we're down like what, 20% year over year right now.
Okay.
5,500.
It depends on which metric you're using. If you're using the S&P, I think it's 18.5. So yeah,
Okay.
close. Nasdaq's down. Let me double check here.
Like 30.
Oh, I think it's down. Hold on. 33%.
Ouch. So that's year to date from January to now, right?
Yes, that's year to date.
Well, hey, I believe in Santa Claus. He's going to come and rally.
So here's the problem. I'll have to go find the pictures. I don't know where they're at, but I had overlaid 1970s inflation along with the 2008 crash.
Hmm.
And we're following both 1970s inflation patterns as well as 2000 stock market patterns. And right now in that pattern, we're at the final hump before the market completely fell out beneath itself.
So how much further do you think we have? We can go like 50% down?
I think in order for us to fix what's happened, we need to go into a Great Depression state. Truthfully, I think best case scenario, if what I think happens, let me just map it out real quick. Where's my thingy? There it is. I I think we need to really go like a total of 33% down, like
Mm.
30%. If we take that from where we're at today, another 20% or so, another 30%. The S&P needs to get between 2,800 and 3,200 realistically.